If you walk into a bank and ask for a loan to open an independent restaurant, they will likely deny the application. The failure rate is simply too high. But if you walk in and ask for a McDonald's, the vault opens. A McDonald's location functions as a mathematically precise cash flow system, offering a level of predictability that independent restaurants can't match. Because the revenue is so consistent, the corporate parent selects operators through a multi-year vetting process designed to filter for extreme operational discipline. Buying a McDonald's means acquiring one of the most rigorously gate-kept, bankable assets in the modern economy. You just have to survive the buy-in first. You need $500,000 in liquid cash just to sit at the table. To build the location, that requires $1.5 to $2.5 million in total investment. Finally, you must spend up to 2 years working inside a franchise, completely unpaid. Entrepreneurs willingly subject themselves to this financial and physical gauntlet for a very specific reason: the massive revenue potential. An average location in the United States pulls in roughly $3.6 million in gross sales every single year. But top-line revenue is often an illusion. We need to track exactly where those millions disappear to on the balance sheet before the owner actually takes anything home. This circle represents the $3.6 million revenue pool. Let's start slicing. 30% goes to the supply chain, raw food and packaging. 28% compensates kitchen staff and managers. Then 12% disappears into localized overhead, covering electricity, maintenance, and insurance. At this point, nearly 3/4 of the gross revenue is entirely gone, and the parent corporation hasn't even collected its baseline fees. Every month, corporate takes a mandatory 4 to 5% franchise fee, plus an additional 4% contribution to the National Advertising Fund. Standard restaurant costs and royalty fees certainly take a massive bite out of the profits, but the true engine of corporate wealth extraction operates through a completely different layer of the balance sheet. McDonald's Corporation operates a multi-billion-dollar commercial real estate portfolio, positioning itself as a landlord that utilizes fast food to pay the mortgage. Corporate owns the land beneath the store. The corporate strategy involves independently identifying, purchasing, and holding prime commercial land at the busiest intersections in the country. Once they secure the lot, corporate constructs the physical shell of the restaurant and explicitly leases that building back to the franchisee. This diagram outlines the lease structure. The franchisee contractually agrees to pay either a fixed base rent or a percentage of their monthly gross sales. The critical clause is that the contract automatically defaults to whichever number is higher based on the individual store's performance. If a local store struggles, corporate still gets paid their base rent. If the store booms, corporate takes a bigger slice of the upside through the percentage clause. The parent company captures the financial upside of a thriving location while pushing the daily operational risks entirely onto the individual store owner. This waterfall chart steps down through supply chain, payroll, royalties, and rent. The owner takes a capped net margin of 5 to 8%, which equals roughly $200,000 to $280,000 in annual take-home pay. While that is an objectively high salary, it looks much smaller when weighed against the $2.5 million of personal capital the franchisee placed at risk. These thin margins mean that while a single store provides a significant salary, the capital-intensive nature of the model makes it difficult to recoup that initial investment quickly. The true path to wealth in this system is found by multiplying that fixed net margin across a vast geographic area. To justify their initial investment, a franchisee must transition away from being a restaurant operator. They have to become a localized portfolio manager, overseeing 5, 10, or 20 units. This reveals what an applicant is actually purchasing when they hand over millions of dollars in startup capital. They are buying the privilege to become a highly vetted, incredibly reliable, well-compensated tenant servicing the parent company's assets. The franchise formula relies on thousands of individuals absorbing the localized risk of running a restaurant, allowing the corporation to safely collect the rent.